You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
In March of last year, the WHO announced the global pandemic. And here we are 1 year later. How has this pandemic affected real estate? And today, specifically, we're going to talk about commercial real estate. I'm Kathy Fettke, and welcome to The RealWealth Show. Our guest today is a principal of the Boyd Company, one of the nation's most trusted and well-known corporate site selection firms. Boyd clients include Boeing, Chevron, PepsiCo, Visa International, Shell, Honda, Hewlett-Packard, and more. John's expert perspectives on corporate site selection, economic development, and the real estate industry are routinely featured in the global news media. And he's with us here today. So, John, welcome back to the RealWealth Show.
Hey, Kathy, it's great to be with you.
There's been a lot of changes since the last time we spoke. We were really worried about commercial real estate 6 months ago and where that was headed. Where are we today in 2021 in regards to commercial real estate? And I know that's a big question because there's lots of different kinds of commercial real estate.
Well, we're certainly in a much better place today than we were the last time you and I had spoken. We last spoke about a year ago when the Dow dropped, the biggest drop since 1987. There was a time of just tremendous uncertainty. We're entering this horrible pandemic, shutdowns. It's a much different outlook that we have today, obviously. We're beginning to return to normal. The economy is recovering. And there's a lot to feel good about and excited about the year ahead.
Well, that's great news. So now you are a consultant, I believe, to companies that are looking for the right site for their commercial property, right? So what are you seeing now? Are you seeing companies being aggressive and trying to tie up land and build things, or what's going on out there?
We are. This is an era of unprecedented mobility for both companies and for people. We're very busy today advising companies to realign their office space with trends that reflect hiring patterns. Of course, the remote workforce trend has been a major theme throughout the economy. Remote working was a trend prior to COVID. COVID accelerated the remote working trend. We expect it to be an enduring trend. And based upon what our clients are telling us and what we're planning with our office projects, we expect more of a hybrid scenario where office spaces will continue to get smaller. It'll be really a people-first approach to economic development. And then the other dominant theme that we're seeing on the industrial end is this idea of last mile distribution for goods and services and reshoring, which has been a major focus of both parties over the past several years to bring back supply chain manufacturing back to the U.S.
Would you say that is still in play? We're seeing more companies bring jobs back?
Well, quite frankly, we're concerned about some of the new tax increases on the horizon. Increasing the corporate income tax rate to 28%, I think, is going to be difficult for companies. And it's going to slow the pace of reshoring. And I think a lot of companies that want to bring operations back to North America, okay, the silver lining with COVID, it underscored the danger of having your supply chain concentrations in Asia. So a lot of companies want to do business, bring their operations back to the US. What we see happening is Mexico and especially Canada emerging as real nearshore alternatives to the US because of the increase in the corporate income tax rate, where our clients are asking us to look at alternatives in Mexico. Sonora is really hot right now. And in Canada, Ontario, Eastern Ontario, Montreal and Toronto for the banking and finance sectors are in the mix for a lot of projects that otherwise would have been in the US. But there's a lot of hesitancy now, given some of the new tax increases and new regulations that are coming. You know, one of the things buried in the $2 trillion stimulus package was $60 billion of new tax increases and a lot of limits for corporate deductions, which is going to slow the pace of not just hiring, but also companies buying materials and goods. So that's alarming to us, and it's going to slow the pace of our economic recovery.
Interesting. So you're seeing companies choose to move their businesses to Canada or Mexico because the tax is different?
Right. The corporate income tax in Canada is 15%. That's going to be roughly half of what the corporate tax will be when we increase it to 28%. When you factor in the favorable exchange rate and the nationalized healthcare system, which lowers which lowers healthcare costs for employers, those operating cost savings become enormous. And so a lot of our clients are beginning to look at Canada as a real premier, preferred, nearshore alternative to doing business in the U.S.
So when those products come over the border, will there be tariffs to make up for that difference or not?
Yes, I mean clearly we've been realigning our trade policies uh, to promote reshoring. One of the policy objectives of the Biden administration is to proactively punish corporations that are moving their production and their offices to Mexico and Canada. We'll see how that plays out. At the end of the day, corporations will be studying the numbers very closely, and it'll be difficult to really tax companies to the degree where those operating cost benefits and tax savings don't outweigh any type of potential surcharge or penalty, if you will.
Fascinating. All right. So coming back to office space, I mean, a year ago, I was very concerned about office because companies were suddenly learning that they didn't need an office, or not all of them did, and that remote work could be even better for their workers. And so are you, when you say that companies are still looking for office space, but they're redesigning it, what does that look like?
Well, projects are getting smaller. About a decade or so ago, the average square foot per worker for one of our office projects was about 200 square feet per worker. Today, it's about 100 square feet per worker because companies are in a cost-cutting mode. They want to reduce their brick and mortar Class A office space commitments, and they want to incorporate this idea of remote working. The cost savings for companies are enormous, and there's more data now, HR data that shows that overwhelmingly employees want the option to work remotely, at least on a hybrid basis. So moving forward, many of our clients are viewing the office really as sort of a space station where workers report maybe once or twice a week. Some companies will incentivize their workers to be in the office more. Some companies will encourage their employees to spend less time in the office. That'll really be company specific. But over the next several years, we expect a slow return to the office, and it'll be more of this hybrid approach. And that has enormous repercussions, not just for the commercial real estate market, but also the housing market. And it's one of the drivers for the mixed use development, this idea of live, work, and play.
Yeah, I was just going to say, obviously, our audience is more interested in the residential side of it, but our residential is tied to commercial. It's tied to where their jobs are usually. And we've seen that change a lot this past year, where people making pretty large salaries that usually afford a big city lifestyle can now move to a small town and can easily afford a home in a smaller town, which is, of course, driving prices up there. So are you seeing that trend continuing where people will be able to live in more affordable places, but kind of work from anywhere? Or are you seeing the businesses moving to those more affordable places as well?
But a lot of the high growth markets are beginning to experience inflationary wage pressures and inflationary real estate costs. From a housing perspective, the biggest issue we have, of course, is the lack of supply. We expect housing starts to increase over the course of 2021 as developers have more confidence with the economic recovery. Millennials, of course, are driving this. Millennials, which have put off buying a home, or increasingly getting in to the home buying market. So we think that'll obviously be a major catalyst of new development. And a lot of this will be on the mixed use front. It'll be in markets that have a low cost of living and offer the types of lifestyle amenities that young workers want. The biggest part of our labor force today is the millennial workforce. It's the most studied demographic, I think, in human history. And they're very receptive to this idea of live, work, and play. And some of the most exciting development activity we're seeing in North America today are mixed use developments. And it's really become a major industry attraction tool for elected officials and for economic development officials to really promote a major draw, a major signature mixed use development, whether that be Riverton in New Jersey or the Woodlands in Houston or Ovation in Cincinnati. Rio del Rio is a very one that we're very high on in Sacramento. And you're seeing that this become a major theme and narrative in the economic development messaging today.
So you believe that people will want to interact and hang out in large groups again sometime soon?
Yes, I think fortunately we're getting COVID behind us,
Hmm.
and it's the vaccines are ramping up. All of that is encouraging. The data trend has been very positive over the last several weeks. Let's hope that continues. I think
Hmm.
we're all ready to get back to normal. I certainly I can't wait to get back to normal. I miss traveling and all the normal things that we've you now appreciate again.
Yeah,
Uh,
just
uh,
literally eating in a restaurant is a big deal.
yes, and you're in California, and you've really
Yeah.
suffered with the some of the more stricter lockdowns. I live and work primarily in South Florida, and we've been much more open.
Oh, you didn't feel it much. I mean, I'm not complaining. Having I had to be forced to stay home in order to stay home. I had been traveling so much. I actually really appreciated that time at home with my family. And it's going to be actually harder for me to get back on the road because it's been so nice. But yeah, of course, I went to visit my brother-in-law in Tahoe for his 70th birthday, and he's an incline on the Nevada side, and they're allowed to eat indoors, and we just it was just such a treat. We hadn't had the chance to do that for so long. Yeah. So, what about hotels and restaurants and that sector that's been hit so hard?
Well, look, I think that'll be one of the last areas of the economy to really rebound. But as corporate travel begins to pick up, as some of the lockdowns in major cities begin to ease, I think capacity rates in Manhattan are going up next week. I think all of that will be good for the industry. There's some new trends also in the restaurant industry. I think this idea of ghost kitchens and incorporating a lot of the virtual technology platforms is something that a lot of celebrity chefs are jumping on that bandwagon and working with some of the nation's top developers and hotel operators to incorporate that technology. I think that's exciting.
I don't know
And
what that is. A ghost
it,
kitchen?
yeah, this is a kind of a new emerging industry. And we talk about this COVID pandemic and the economic devastation it's caused, but it's also been a time of great innovation where companies are creating new efficiencies with new virtual technologies. And the restaurant industry is really adapted, where your signature chefs are doing takeout only operations and incorporating a lot of the virtual technology. Watch over your food being prepared. There's an entertainment aspect to that. A lot of the Instagram influencers are getting on board with that scenario. So, but I think a return to traditional dining is something we all want to happen, hopefully sooner rather than later. And I think we're getting very, very close. Uh, and with respect to the hotel industry, we expect corporate travel to obviously and leisure travel to really pick up. People are excited to get back out again, and the hotel industry is adapting. This idea of the staycation is being embraced by brands like Marriott and Hilton, and leveraging the remote workforce trend where you can do extended stays and work by the pool. I think that's a very modern, hip, exciting theme. And you're seeing hospitality markets like Orlando and Las Vegas and Reno incorporate that into their offerings. I think that'll be something that's here to stay. I think the idea of a staycation is going to be a big part of the corporate travel market in the months and years ahead.
Interesting. Yeah, we have two single family subdivision developments in the Reno area. And boy, oh boy, the last few months, there's been obviously incredible appetite for those homes were sold out. And then in Carson City as well. So, all right. Well, what do you see with lending? I know I just spoke with a lender yesterday. Rates went up, at least for investor properties. Do you believe that rates will stay low, or are they going to continue to tick up?
I, Obviously, we have record lows. That they are going up. We expect them to tick up this year, but I expect them overall to stay low. I think that's been every indication we've had will be that they will stay low. It's really a question of inventory increasing with respect to, I think, pricing. But yeah, I would expect rates to gradually tick up, but still remain low.
Yeah, I did read recently that even as the economy improves, the Fed is still going to be continuing to buy bonds to keep those rates low. So good for us. Good for us. So we talked a little bit about the new stimulus bill, and I hear there's another one around the corner for infrastructure growth. So we're printing lots of money, trillions. 5, 6 trillion. I don't. Who knows? Who knows that? I don't know the Fed if the Fed's ever been audited to really find out. But what is the impact, do you think, on real estate given another $1.8 trillion will be circulating?
I mean, long term, it's a challenge for our real estate and for our overall economy. The idea of reckless spending and borrowing, and of course, the new $2 trillion, the new tax increases that are going to slow our recovery and our economic growth. In the short term, a new infrastructure bill will be a catalyst for a lot of exciting development activity around the country, roads, bridges, and which our nation relies upon to be competitive in the global economy. Deepening of ports is something that I expect to be a part of the stimulus package. New clean energy grids. We saw what happened in Texas. I think energy security is a major theme for our economy moving forward. Our clients in New York a couple of years ago were very excited about another tunnel under the Hudson River. The joke now, not to sound skeptical, this massive migration of people out of Manhattan to Florida, maybe that new tunnel will just make it easier for people to get out of New York and to the Carolinas and Florida. But, we'll see how that plays out.
Well,
A SALT deduction, by the way, you talk about policy out of the administration affecting blue states. Beyond bailouts, I think repealing the SALT deduction at 10,000 will provide some relief for California and for New York and New Jersey. And it'll at least give a narrative, it'll at least maybe perhaps give a second thought to someone contemplating a move out of those states if they can deduct more of their property taxes.
Well, yes, and kind of what I was getting to on the new stimulus. We know that only a little bit is going towards actual COVID issues, and the rest is going all over the place. But how will that affect real estate values? We know that in the past, when there was that kind of stimulus, that money went to stocks and to real estate, and prices went up. Do you see that kind of inflation with real estate?
It's difficult, and I want to be optimistic. It's difficult to expect this type of continue record run that real estate has been on. It's sort of been detached from a lot of the fundamentals of the overall economy. I'm very much engaged in the real estate market, both residential and obviously commercial real estate, with what our firm does. But there are significant fundamental challenges looking ahead that our lawmakers need to deal with. But again, in the short term, there are a lot of exciting drivers that we see. More millennials getting into the home buying market. The idea of more mixed use developments, I think, is exciting. But yeah, obviously there's big picture, long term challenges that our policymakers need to deal with.
What would you say is the most concerning?
Borrowing, taxing, and spending.
Yeah. I mean, what would you say is the most concerning? Is it that we're going to see higher taxes soon, or what?
Yeah, I think raising taxes is a major priority of the Biden administration. Wants to target Americans earning more than $400,000 a year with new taxes. The increase in the capital gains tax and the estate tax are especially troubling, and will have a big impact on the residential real estate. It'll give pause to a lot of middle class people looking to really buy discretionary things like a second home, a vacation home, investment properties. All of that will be affected by an increase in the estate tax and an increase in the capital gains tax.
Hmm. Interesting. What else do you think policymakers should be considering?
I think we have to realize that we have a new administration that has a much different posture on taxes and spending and regulations than the prior administration. Fortunately, in the U.S. system, politics is cyclical. We have another election cycle coming in just a couple of years, and these issues will be hotly debated. I think when Americans see rising gas prices and they see taxes going up, that may influence the dialogue, and it may influence what the priorities are moving forward.
I just honestly, it seems like at this point, voters don't have a lot of control about how politicians spend their money, regardless of party. Since Bush, then Obama, then Trump, and now with Biden, printing money
That
has
is
just become the way it is.
that's a theme that we're seeing, Kathy. This idea, this last stimulus, really being talked about as a prelude to basic income, and not to get political or really aggressively, advocate policy, but that's a real game changer for the U.S. And we incentivize people really to look for alternatives other than secure employment. That's a real game changer for our economy moving forward.
Hmm. Yeah, I mean, the money's we got to be producing something,
Yes.
Money doesn't actually grow on trees unless you own real estate these days. It sure seems to.
And
All right.
that's my thought. I mean, that's so many Americans now view the government as a source of wealth
Hmm.
and not the private sector. So,
And confusing that the government is something other than us, when actually the government's funded by us and government money comes from us. So,
right.
when I tell people, where you're receiving these checks, well, you're going to pay for that. You're going to pay through inflation. You're going to pay through taxes.
Absolutely. And as we raise the corporate tax, a lot of that increase will fall upon consumers as
Yeah.
it becomes more costly for companies to do business. The consumers will bear a greater burden of that. In addition to less hiring, less buying materials and goods, and also fast forwarding into the artificial intelligence and robotics era, when it becomes just more efficient for companies to really streamline their workforces and
Mhm.
really go all in on robotics as opposed to hiring people. That's another part of the story that I think will be told more in the months ahead, especially as companies, high-profile companies that want to do business in the U.S., trophy employers, make those moves to Mexico or Canada.
Mhm.
Reshoring was the big buzzword over the past several years. Now you're hearing more about nearshoring.
Mhm. Oh, interesting. Well, what U.S. cities are thriving today?
There's a common denominator among cities and states that are doing well. These are cities that are holding the line on taxes, that have a pro-growth strategy. States like Florida and Texas, and Nevada, the Carolinas, Arizona, Utah. These are states that are attracting people, while states like New Jersey, New York, Connecticut, and California are stuck in this perpetual game plan of borrowing, taxing, and spending. These are states that are losing thousands of people each year. For the first time in the history of the census, New York and California will lose representation in Washington, while states like Florida and Texas are gaining representation in Washington. That's a real indictment, and it underscores this new economy that we're in. We talked about companies being more mobile than ever. People are more mobile than ever because of the technology that didn't exist a decade or so ago. So it'll be more difficult for lawmakers and policymakers to mask a lot of those fundamental business climate challenges in the months and years ahead.
Very interesting. Well, you've got demographics that uh, really tell the story. And when you've got so many baby boomers looking for a more affordable place to live that doesn't have such high state income tax, they're going to be moving to those states, and they have been. But now you've got the Gen Xers and millennials looking for the same thing, looking to have a lifestyle that they can afford. And especially if you're not in traffic for 2 hours, you get to work from home, and that's 2 hours added to your day.
Right.
It's going to be interesting to see where people spread out and which towns will grow as a result of that. That's what we're really focused on. So looking at that on the small tier, which towns, and I'm not sure if you have the information on this, but which smaller towns do you see growing the most over the next decade?
I think suburban Indianapolis, Carmel is in Hamilton County, Indiana, is a market that we see is continuing to be high growth in the months ahead. Columbus, the Dublin submarket, the Dublin suburban market, one of the most attractive suburban markets in North America today. We see Central Texas continuing to grow. Florida, of course, continues to do everything right from an economic development and people attraction strategy. The Carolinas are certainly well positioned. And Northern Nevada, I know you're very invested in Northern Nevada. The Reno market is one of the more exciting IT markets in North America today. Great tax climate, great in-migration of intellectual capital from the Bay Area. And a lot of those smaller markets, Gardnerville and Minden, are on the radar screen like never before as up-and-coming suburban areas where there's an abundance of land and people moving in the surrounding areas looking for opportunities.
Very exciting. All right. Well, John, as always, it's been a pleasure to have you here on the Real Wealth Show. Thank you so much for enlightening us with all this great information.
Thank you, Kathy. I appreciate it.
If you'd like to get more free data on some of the strongest post-pandemic markets in the U.S., you can go to our website at RealWealthShow.com. Just click on the Invest tab and you'll see a drop-down of the cities that we think are the strongest for investing in buy and hold real estate. Again, that's RealWealthShow.com.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to RealWealthShow.com.